Ladies and gentlemen, thank you for standing by and welcome to the Yiren Digital First Quarter 2020 Earnings Conference Call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question at that time, you'll need to press star 1 on your telephone. I'd now like to hand over to your first speaker today, Ms. Lydia Yu. Thank you. Please go ahead.
Thank you, and welcome to Yiren Digital's First Quarter 2020 Earnings Conference Call. Today's call features the presentation by the founder, chairman, and CEO of CreditEase, and CEO of Yiren Digital, Mr. Ning Tang, CFO of Yiren Digital, Mr. Zhong Bi, and CRO of Yiren Digital, Mr. Michael Ji. Before beginning, we would like to remind you that discussions during this call contain forward-looking statements made under the Safe Harbor provisions of the U.S. Private Securities and Litigation Reform Act of 1995. Such statements are subject to risks, uncertainties, and factors that can cause actual results to differ materially from those contained in any such statements. Further information regarding potential risks, uncertainties, or factors is included in Yiren Digital's filings with the U.S. Securities and Exchange Commission. Yiren Digital does not undertake any obligations to update any forward-looking statements except as required under applicable law. During the call, we will be referring to several non-GAAP financial measures and supplemental measures to review and assess our operating performance. These non-GAAP financial measures are not intended to be considered in isolation or as a substitute for the financial information prepared and presented in accordance with U.S. GAAP. For information about these non-GAAP measures and reconciliation to GAAP measures, please refer to our earnings press release. I will now pass it on to our CEO, Ning, for opening remarks.
Thank you all for joining our first quarter 2020 earnings conference call today. The first quarter of this year has been a challenging one as the coronavirus shocked the entire global economy. During this unprecedented time, our core businesses remained stable while we made substantial progress to diversify and enrich our business lines and continue our business transition to China's leading digital personal financial service platform. We took proactive measures to ensure our business operating at a healthy level, giving customers the best service we can offer, making our own contribution to fight against COVID-19. Now let me talk about our credit tech business. To maintain business resilience and to position ourselves for the long term, we were focused on 3 areas in our credit tech business this year. First, stabilize and improve risk performance. Second, invest in new areas of growth. And the third, grow our institutional funding mix. I'll now talk about our actions in each of these areas. Our first priority is stabilizing and improving risk performance. In the first quarter of 2020, loan originations decreased 77% from prior quarter to RMB 1.8 billion. As we proactively tightened credit and decreased the business volume to control credit risk in light of the COVID-19. Our fast and timely response allowed us to operate at profitable level in the first quarter despite a challenging micro environment. Our second focus is on exploring additional opportunities and investing in new areas of growth. We have recently launched several new credit products to diversify our loan portfolio and to better meet a full spectrum of mainstream consumer credit needs. The short tenure, smaller ticket size revolving loan product offers credit solutions for a wider range of online and offline consumption scenarios, including travel, lifestyle, e-commerce, and the mobile wallet. This product has been very well received growing more than 100% month over month. For this product, we will partner with large traffic channels like Xiaomi and Oppo Finance, so that we will be able to significantly expand our business with diversified consumption scenarios, reduce customer acquisition costs, and improve operating efficiency, as well as portfolio quality. Last quarter, we mentioned that we will be rolling out auto loans this year, as auto loans typically have a better risk profile than unsecured consumer loans. Our auto loan segment has shown a visible growth momentum since March, and in particular, our auto leasing business is estimated to reach RMB 1.5 billion in loan origination in the first half of this year, and we expect this product segment to be one of the main revenue drivers in the second half of this year. In the second half of the year, together with our channel partners, we also hope to build a consumption platform to enrich our credit ecosystem with a member-only online e-commerce platform. Our third area of focus is on growing our institutional funding mix. We are pleased to report that our institutional funding mix has increased to 40% in the first quarter of 2020, up from 14% last quarter, and we expect this proportion to increase to over 50% in the second quarter this year. We are also actively expanding our institutional partners from banks to trust companies, other licensed financial institutions, and the consumer finance companies. Next, on wealth management, our online wealth management business has seen strong growth, in particular for non-P2P wealth management products and services. The number of non-P2P investors increased by 23% from prior quarter to 26,436 as of March 31st, 2020. The AUA of non-P2P products increased 67% quarter over quarter to RMB 1.7 billion. Average investor investment amount of non-P2P wealth management products has seen steady growth to 65K RMB, up from 48K RMB in previous quarter, driven by both increased investment amount for single product as well as multiple product selection, representing good progress in our efforts on developing investor habits in using an asset allocation investment strategy. For mutual fund products within wealth management, we witnessed strong demand during the first quarter, with AUA increasing by 17% and with sales volume increasing by 30% from February to March 2020, driven by our new product offerings. We expect this growth trend to continue through the year. We have also been investing in investor education through a variety of online courses to help investors develop a long-term investment horizon. And we also noted a significant improvement in average AUA per investor in mutual fund products, which has increased to RMB 36.8K in March 2020. With that, I will now turn the call over to our CFO, June, who will discuss our financial results for the quarter.
Thanks, Ning. Hello, everyone. For our financial update, I will focus on key items of our business operation and financial performance, and you can refer to the detailed financial results in our earnings release. Under the challenging operating environment amid the pandemic in the first quarter of 2020, we maintained profitability and a strong liquidity position. Loan originations for the quarter was renminbi 1.8 billion, a drop of 77% quarter-over-quarter, mainly driven by the COVID-19 outbreak, which heavily hit our offline lending business. More specifically, due to the temporary closure of our physical branches as well as our call centers, which are based in Wuhan, we saw a significant drop in loans originated from offline channels as compared to prior quarter. Total net revenue was renminbi 1 billion, down 57% from previous quarter. Despite significant business volume drop during the quarter, our strong cost control and operation efficiency efforts have kept our business at a profit and a good cash position. The sales and marketing expenses reduced by 45% to renminbi 616 million. Net profit for the quarter was renminbi 19 million, representing a 95% decrease quarter-over-quarter. As of March 31st, 2020, our cash and the cash equivalents remained stable at renminbi 3.2 billion. We are expecting major business rebound and a substantial growth in the second half of the year as our shorter-term, smaller ticket size loans are quickly ramping up, along with other new credit products launched in the second quarter. Plus, a comprehensive consumption finance ecosystem is being built with rich and diversified external partners on various platforms. On wealth management side, as of March 31st, 2020, Yiren Wealth has served approximately 2.2 million investors cumulatively, and close to 221,000 investors currently hold an investment on our platform. The total AUA for Yiren Wealth reached RMB 32.2 billion as of March 31st, 2020, with an average AUA per investor remaining stable at RMB 146,000. For this quarter, our account management service fee, which is mainly from our wealth business, was renminbi 413 million, a relatively modest decline of 16% quarter-over-quarter. The allowance for contract assets has declined to renminbi 143 million from prior quarter due to the overall lower loan volume, and allowance was equivalent to 7.8% of the loan volume, as compared to renminbi 588 million last quarter, which was equivalent to 7.4% of loan volume. Meanwhile, contributions to the credit assurance program was at 12% this quarter to ensure adequate coverage. The decrease of 2% as compared with the last quarter was the result of shorter loan tenors and tightened credit control on new customers. Our credit assurance program remains adequately funded with a total balance equivalent to 10.5% of the total performing loans. With that, I will now pass it on to Michael, our CRO, for an update on credit risk.
Thank you, John. Hello, everyone. For credit performance and the risk management, overall, early delinquencies increased in the fourth quarter and reached its peak at the end of March due to the pandemic situation, before it quickly declined in April and returned to near pre-pandemic level in May. More specifically, 15 to 90-day delinquency rate stood at 8.9% as of March 31st, 2020, compared to 4.8% as of December 31st, 2019. However, the delinquencies dropped quickly moving into April, thanks to our tightened risk policy and efficient risk management. As of end of May, delinquency rates for 15 to 29 days, 30 to 59 days, and 60 to 89 days had already declined to 1.3%, 2.2%, and 2.1% respectively. And we expect delinquencies to further improve in June. Meanwhile, visible progress has been made in prioritizing our business toward higher quality customers, which was reflected in risk performance improvement. Looking at our vintage performance, we are glad to see essential improvement trend in 2019, and we expect a more substantial improved trend in 2020. I will conclude my prepared remarks here and give it to the operator. Operator, please continue.
Thank you. Ladies and gentlemen, if you'd like to ask a question, please press star 1 on your telephone and wait for your name to be announced. Once again, that's star 1 to ask a question. Our first question comes from Alex Yi from UBS. Please go ahead.
Hi, good morning, everyone. Thanks for taking my question. So I have a couple of questions about your the credit business. So first of all, is on your traditional large size, ticket size unsecured business. So could you just remind me what's your strategy on this specific loan product going forward? So we have seen your repeat customer borrowing for this quarter is almost zero. So going forward, are you going to completely wind down this business? So what's the strategy on it? And also, will it be still offline or online? And second question is about your auto loan. So given you expect that it's going to be a major contribution to your loan facilitation volume in the second half of this year. So may I just ask for more color on it? So for example, what's the specific product features, like in the used car or new car market, and where was your customer acquisition channel? I guess it's still mainly offline, right? And so what's the funding coming from? Where does that funding come from? And my last question is about your loan mix outlook for this year. So given you also have the sort of term 10-year products, just wondering if you could give us some guidance on how you plan to maintain your loan mix in the near term and also from a longer term perspective. Thanks.
Okay. Thanks, Alex. I'll try to answer your question, and then maybe Bijong can add on any of the points that may be missing. So from the large ticket size traditional loan we have, our strategy right now is that for the online business, we're going to focus on the smaller size, shorter tenure revolving loans, as we mentioned in our remark, and it's actually getting very good tractions. And then for the larger ticket size traditional business, we'll continue to operate, but mainly on our offline networks, because that does have a unique credit screening process that helps us to improve the quality of the loan asset performance. The reason that in the first quarter the repeat business was significantly lower is that first, for the online business, we're moving to the higher credit grade. So we significantly changed the customer segmentation. And then for the offline, as our CFO has mentioned, it was impacted by the pandemic situation. So the productivity really dropped significantly for the offline operation. So that's why the repeat business is pretty low in the first quarter. So in terms of the auto loans, we actually have two type of auto loans business. One is that we have been already operating, which is the borrowers that you already have cars. So basically, it's a credit enhancement business, and that business is actually, as we mentioned, it's going to ramping up to 1.5 billion in the first half. This business has shown quite well credit performance. The ticket size and pricing is rather similar to the larger ticket size traditional consumer loans we have. 70 or 80,000 per loans, 36 months, 24 to 36 months, and the fees are relatively similar. However, the credit performance is actually significantly better. If you think about the full vintage charge-off, it's in the mid-single digit level. So as you can see, it's quite profitable business. And from funding perspective, we're working with licensed financial institutions to provide the funding for this type of loans. And then we are starting the second-hand car consumption loans, basically at the point of purchase. For this, as you know, it's also an offline-driven operation. We are building the team and getting very early good tractions. The channels will be from the auto cars, sales centers. Also, we're working with some online auto channels that we hope to do online to offline conversions as well. And then for this business, will all being funded by institutional fundings. And then in terms of the loan mix towards the year, from online perspective, the shorter term revolving loan will be majority going through the year. And for offline, you can think about the auto loan and the traditional larger ticket size consumer loans half and half. So that will probably reduce our overall loan tenure to more close to 20 months from previous, more 30 months range as we go through, building up the volume through the year. See if Bijong, you have any add to this?
Well, I think you answered fairly thorough. Just probably add one more point. Well, our funding partners, their risk appetite towards a longer tenor loans significantly reduced towards lower tenor loans. So that's why represented by Danny's remark. Average loan tenors in Q1 reduced to 22 months versus Q4. And we foresee the average loan tenor will continue to reduce. And so it will be easier for us to secure institutional funding. That's all I want to add.
Okay, thanks.
Okay, thanks. Very clear. So just want to add a bit of follow-up question. So first of all, on the loan mix, so for the online and versus offline, could you also give us a color on how you're planning to split the two in terms of volume for this year? And second, so about your short-term revolving loan, do you have an expectation about the current vintage loss rate on that particular product type? And lastly, on the, could you also give us some update on your P2P operation? So, like you also have some funding coming from P2P in Q1, and what's the current status on the compliance perspective? And would you to what extent do you expect that funding source to continue in the rest of this year? Thanks.
Okay. So I think maybe I can answer the online-offline split. It's around 50% from sales volume perspective, and it's probably going to maintain that way. through the year. As you can see, the major part of the auto loans are classified in offline, so that's going to be important portion, and plus the traditional larger ticket size business, we're continuing to ramp up, recover the volume. I think maybe Michael can actually give comments on the credit performance expectation on the shorter term loans, and later on, we'll talk about the P2P operation and compliance status.
Thanks, Dennis. Yeah, let me take on the question for the shorter term revolving loan credit performance. For this type of loans, we are expecting to see the performance to be on par to our competitors. From the vintage performance perspective, it should be in the single digits. Because we have a pretty well-defined, well-established, and tightened credit screening process at the acquisition. That is to ensure our credit performance will be at the market level. As to the next question, probably I will give back to Dennis about the P2P operation.
Yeah. I think from funding mix perspective, as we mentioned, we already reached more than 50% of the new sales volume funded by the institution, and we have sufficient funding sources and partners that will be able to significantly increase that portion of the funding of our total business volume. However, at this current moment, our P2P operation are still operating with the compliance with our local regulator. So we'll see how that part regulators requirement will evolve, and then we can always adjust accordingly, so that we can switch up our institutional funding to meet all the demand if we need to. Right now is more of our own judgment. We're continuing to operate both funding sources in parallel.
Okay, got it. Thank you.
Once again, if anyone would like to ask a question, please press star 1 on your telephone and wait for your name to be announced. Our next question comes from Daphne Poon from Citi. Please go ahead.
Hi, good morning. Thanks for taking my questions. So just two questions from me. The first one is regarding your loan volume. So just wondering if you can give any color on in terms of what level of loan origination volume you are seeing or expecting in the second quarter, and also would you have any rough guidance on a full year basis? And then the second question is regarding your account management fee. That if I understand correctly, most of the fee is still coming from the P2P part that you basically you get to earn the spread between your actual return versus the expected return that you are offering to investors. So currently the fee rate is actually quite high. It's at around 5% annualized of your average AUM. So I'm just wondering if you continue to shrink your P2P business while ramp up the non-P2P part, should we expect this fee rate to decline? And if you can share what is the fee rate for the P2P part versus that of the non-P2P business? Thank you.
Okay. So I will try to answer this question, and Bijong can add in later on if anything points. So from the loan volume perspective, as we mentioned before, we're still on our planned trajectory to recover and ramp up our overall long volume sales volume run rate back to our 2019 average level by mid or later part of second half of this year. If you look at our 2019 quarterly run rate, it's probably around 10 billion, 8 or 9 to 10 billion level. So divided by 3, that's a monthly run rate that we're targeting by the mid of the second half. As for full year, we don't want to give a guidance, but you can use that math, try to curve it up. Then you probably can get an estimate assumption on the our sales volume for the year. But however, as you probably also want to look at the revenue side, as we have more multiple streams of revenues now. That probably gives you a better sense of our business and scale and growth. In terms of account management service fee, yes, you're right. I think majority of that's still coming from the balance of the P2P amount. As we are shifting more from the P2P investors into more institution investors, actually that the revenue opportunity is not missed. It's just that going to be captured from the revenue take rate upfront. So we're not missing that part of revenue. Of course, if our new loan origination volume does not catch up to the repayment schedule of the remaining loan balance, overall ending balance dropping definitely going to impact this portion of the revenue coming in. But we think, as we mentioned, we're in the progress of recovering the run rate back to normal. You will see that catch up later on. And then from the non-P2P business, we are ramping up them nicely from both the sales volume as well as the AOA. You have seen that AOA is actually growing very sturdily, quarter over quarter, more than 60%. And in terms of the take rate, I think the standard wealth management product is a bit of it has a bit of different scheme. Some of the product could be 0.5%. Some of the product could be 1%. In particular, if we were able to work with some of the product supplier on a strategic level, exclusive base, we can actually get up to 1%. But at the same time, I think we have mentioned, other than the bank wealth management products, mutual fund products, we're also, introducing the insurance products to our wealth management clients. And as you know that, for the wealth management products, the commission rate is rather high. We're actually expecting some good contribution from this business. So in the mix, we will see whether, overall on AUA basis, we'll be able to reach the similar level. But, longer term, definitely, we're going to see the non-P2P wealth management business to become a significant revenue contribution in 2021 and beyond.
Okay, understood. Thank you.
Once again, if you'd like to ask a question, please press star 1 on your telephone. We've had no further questions come through. Just a final call. It is star 1 if you'd like to ask a question. We have no further questions at this time. I will pass back to management for closing comments.
Okay. Thank you very much. That concludes the call.
Thank you. Ladies and gentlemen, that does conclude the call today. Thank you for attending. You may now disconnect.